welcome everyone to episode 50 of Top of Mind, 50 of Top of Mind with Consilio Wealth. Today is May 31st, beautiful sunny day here in Seattle. How I'll speak for you, I think it's probably sunny down where you are in California. I'd be shocked if it's not. Today we're talking about the VIX, the volatility index. The VIX has been declining for many, many years. What is the VIX? How is it calculated? Let's unpack that for everybody. Earnings has been really good. No surprise. AI mentions broke a record that was set last quarter. We wanted to unpack some of the trends there and some interesting facts that we thought you all would find cool. And then finally, utilities are starting to benefit from AI. There's been some comments and research published that the compute power required to run AI is incredibly more than running everything else. And so multiples over is the amount of power that companies are going to need if this thing becomes full scale. So there's starting to be talks about that. And we're starting to see certain stocks benefit from that. So we thought we'd chat about that too. All right, let's move into our first topic, Hao. So the VIX is around 12. So what's the VIX? How's it calculated? What's it been? What's the trend of the VIX over the last, 5 years?
All right. Yeah, thanks, Chris. And I think it's pretty timely. When we wrote this or start publishing our deck here, the VIX was at 11.9. We just rounded up to 12. Historically, it does hover between 20 and 30. So we're in a historical level where the VIX is low. What the VIX is the fear index. So it's a measurement of how much fear is implied by the market in the future. So it does look at the options activity, futures activity, forward activity, where traders are trading not the S&P today, but they're trading up to 30 days, whether they think the market will go up or down. Right, and that level of up or downness, I guess, will kick back a VIX measurement. Mm-hmm. So the CNN Fear and Greed Index that we've mentioned a few episodes back does pull that as part of the equation for their fear or greed register. I think that what is a big part of the VIX is it doesn't really capture fear in the moment. It's more of like a lagged thing where traders don't have a elevated sense of fear until after the sell-off, right? Mm-hmm. So when we published this in just a few days ago, it was last Friday, May 23rd. It's May 31st now at 10 a.m. Pacific. The index was at greed. Now it's skipped neutral and gone to fear. So I think that's a big thing where, one, you can't really set your clock to this. It's not very predictable. It only happens after we've sold off. So this week, the last week of May, has been a down week for the S&P and the NASDAQ. And then suddenly there's fear in the market. Mm-hmm. You see what I'm saying there? It doesn't really capture like a buy or sell signal ahead of time, but it is very useful to kind of gauge where fear is, right? Or how people sensitive the markets are to sell-offs.
You're saying that it's pretty reactionary, right? So like we were chatting yesterday as we were preparing for this call or for a podcast here, retail sales have been quite volatile. You've seen Target come out, Walmart come out, Costco actually beat, but a lot of companies have really missed earnings by a lot. So retail sales are coming down. And then, yesterday, I think the big news was Salesforce released, and they had their slowest growth since becoming a public company, I think 20 years ago. And the stock went down like 20%. And so I think, anyway, what you're saying is when these types of things happen, stock goes down and then the VIX goes up in terms of the fear goes up. But it doesn't happen in the reverse order. It's not like, the VIX went up, therefore it's a sell signal. It's a reactionary signal to what's happened or the news that was just released.
Yeah. Yeah, and for context, the VIX spiked in 2020, and that spike went up to about 80 for the VIX.
Yeah, that's wild. Yeah.
For reference, we were at 12.2 when we published this last week for our internal purposes. Mm-hmm. And after this week's sell-off, the VIX is approaching 15.
It's a big movement.
Yeah, it is big movement. That was like a 10% jump. But our range for regular VIX, meaning just normal market volatility, it's 20 to 30. Anything below 20 is abnormally low. Anything above 30 is abnormally volatile or fearful. The VIX jumps like in 2020 from, I want to say, around the 20 range all the way up to 80. And that happened in a matter of a few days. That happens. Those spikes, if you look through the history, things look calm and then they spike. So I think what I'm arguing in the newsletter that's going to be going out is when things get low VIX or low fear, a sense of lackadaisicalness or people are just not worried about the stock market, and then the stock market sells off and then suddenly they're worried, right? I think that should be a time to at least get your antennas up and say, hey, things are maybe getting a little too frothy, we like to say. Doesn't mean you need to sell, because all of 2023, the register of the CNN Greed Fear Index, it was vacillating between greed and extreme greed. In 2023,
Really?
yeah, it ended being a really great year, right?
And the VIX
So-
declined all of 2023 too.
Yeah.
It was one of the lowest. So volatility is measured by the VIX. It's also measured by the number of days that number of days that the market moves more than 1%, more than 2%, more than
Yeah.
3%, that kind of thing. And the 2023 calendar year was one of the lowest volatility years on record, meaning you didn't see it in the news to move, but because it moved by 2 or 3% very
Yeah.
often. I think it was a handful of times that it moved 2+% in a day.
And if you use that as a reason to sell off and look out for risk, you would have sat out a whole year.
Yeah,
So
good point.
We're advising. We're not giving advice, but we're saying don't use that as a tool to time the market, because it's not a great market timing tool at all.
In a good year, nonetheless, right? 2022, not a great year. 2023, great year. So the volatility was low, but it climbed back very, very slowly throughout the year, which is very typical, right? The saying of the market climbs the wall of worry. That's kind of what it did in 2023. It was climbing the wall of worry all year.
Yeah, 2022 showed extreme fear. Hindsight, it was a good time to buy, but if you bought early in 2022, you bought at the top, right? And it went nothing but down. So I think the fear, buy, greed, sell doesn't really make for good investment.
It looks like
Results
this
are-
peaked. It peaked in so the VIX, because the market peaked in November of 2021, but the VIX didn't peak until, I'm looking at kind of a chart that doesn't give me months, but I'm going to say like March of 2022. But the market had already sold off a good bit, and then continued to go down kind of until about October, and then reversed course a bit throughout the end of that year. So to your point, this is definitely a lagging indicator, because the market high was 4 or 5 months before the VIX actually hit its high.
Yeah, and I think
All right.
when you see people refer to this, even us, we're not saying buy or sell, right? Like it's more of an indicator of where things probably were in the last day or so.
Yeah, well, and I think that's our learnings here, right? Like the VIX isn't necessarily the greatest. It's certainly not a buy or sell signal, but it is a reflection of the general sentiment out in the market. But it just is a bit of a lagging indicator. So
Well, sentiment tends to follow the market, though, too. When the market goes up, I suddenly feel good. That's always been a bug with me, where people aren't scared until they need to be scared.
Yeah.
And that's after a sell-off.
Yep. Sentiment across the board. That's exactly how it is, right?
Yeah.
All right, let's move to earnings. Earnings has been generally good. So as of the date of this post, so just a couple of days ago here, so 96% of the companies in the S&P 500 reported actual results for Q1 of 2024. Of these companies, 78% have reported actual earnings per share above estimates. That is slightly above the 5-year average of, wait for it, 77%. and above the 10-year average of 74%. In aggregate, companies are reporting earnings that are 7.5% above estimates, which is below the five-year average of, wait for it, 8.5%. Okay, that's a percent below. That's good. I guess they're both a percent below, but 78 to 77 is different than 8.5 to 7.5. But it's above the 10-year average of 6.7%. So, I kind of read that as a giant nothing. But what do you read that as?
I think it could be a signaling. Again, it's just one data point. So this is pretty messy or noisy data where we're talking about spending, right? So we're seeing the convergence of bottom line profits staying above expectations, if not slightly. And then top line expectations, which is sales revenue, come down slightly, or at least the growth trajectory of it has come down slightly. So what I'm seeing from this last quarter is companies are seeing a lot less revenue growth come in. So to be clear, they still grew, but they're not growing as fast as they have in the last however many quarters. Like, the pretty good streak here. So that's probably first and foremost where a lot of companies, like Chris mentioned, noted slowdown in consumer spending, right? Or they're substituting, trading down, or outright foregoing purchases. And the thing with bottom line profits actually kind of growing up means, how are they doing that? How are companies making more money on the bottom line when they're bringing in less money?
I see what you're saying. So let me carry on here. So what I was just reading was about EPS, earnings per share. So ultimately, the amount of money that they're making on their bottom line. Yeah. And it's roughly in line with long-term averages, a little bit above, a little bit below, depending on 5, 10 year. Okay, in terms of revenues, 61% of S&P 500 companies have reported actual revenues above estimates. That is below the 5-year average of 69% and below the 10-year average of 64%. That's a bigger drop. In aggregate, companies are reporting revenues that are 0.8% above estimates, fine, which is also below the 5-year average of a whole 2% and below the 10-year average of a whole 1.4%. So that's actually quite different.
Yeah.
So you're saying revenue growth is slowing and slower than estimates, but companies have been able to do a good job protecting their bottom lines generally.
Correct. Yeah. So I think we're in the midst of them pulling another lever, right? So you could raise prices and inflation, and then McDonald's, Burger King have all
Chipotle,
shown
my
us.
favorite.
Yeah, Chipotle or Taco Bell, all except Chipotle. Chipotle seems to keep
trade like a tech company.
Yeah, their volume.
That's a story for another time.
Yeah, it keeps going with higher prices, but the other ones that have shown some cracks in their armor, like McDonald's, they've tested the upper limits of customer capacity to spend more, right? And I think that coincides with what we're seeing with the broad numbers here, where the spending has been, at least on the surface, more conscious than what we've seen in the past few quarters, right? Because I'm going to raise my prices double, and we're still going to get a line out the door, because that's what we do as Americans, is we spend. And we're seeing it with Expedia, we're seeing it with airlines, we're seeing it with a lot of discretionary type companies. And Nordstrom reported after the close yesterday, and they said a lot more people spent money at Nordstrom Rack, not Nordstrom
trading
proper.
down.
Yeah. So we're seeing a lot of that on the retail front in terms of goods. I think people are just shifting their spending, right? If you go to any resort or vacation area, they're teeming with people who are more than willing to spend. I know it's anecdotal, but I think the companies that have reported, which is the vast majority, are seeing a noticed slowdown from consumers and from other businesses.
I'm noticing a trend when earnings comes out, and I'm curious if you're seeing the same thing. And that trend is, when a company beats earnings, they're generally just saying, like, all of our business lines are growing, or our major ones are growing. Companies are adopting more of the thing that they have. Yeah. And it's just generally a really positive sort of pitch. And on the other side, when companies are missing earnings or giving weaker guidance, they're consistently blaming. They're saying, business customers aren't opening their wallets. That's what Salesforce said yesterday, right? They said, we're noticing renewals to be less. We're noticing, softening. We had these clients we were going to sign, or customers we were going to sign, and they didn't sign. They pushed out a quarter. It seems like that's what everybody's saying, and I kind of want to try to wade through the BS a little bit. Like, do you think that's true? So first of all, are you hearing that too? With companies that are kind of seemingly winning and losing, and then secondly, what do you make of that? Like, what's really happening, and is this just like a sales pitch by the earnings people?
I think it is a sales pitch, to be clear, because they had the same herd pattern in 2022, right? Our main concern is inflation. Now they're shifting from inflation to in recession in 2022 to we're positive about AI, but our spending. So there's cracks in what they're saying, but there's like this big shift with the majority of companies that are saying one thing, inflation in 2022, and now another thing in AI in this year. So I don't know if that's answering your question, but I get I get a sense of herd mentality a lot with these earnings calls.
Well, look, I mean, if you're missing your revenue numbers, it's pretty easy to say like, God, we just can't sell anything, versus like, our products aren't that great, or we need, we're working on making our products more fit to the market, and that's going to cost a lot of money. And, that's a more alarming call to say to shareholders versus like, we've just noticed that business spend is down or something. That seems like a pretty general, like, yep, sounds good. I don't believe that it's actually what's going on with certain companies. Like, I think that certain companies, do they need to hire better salespeople? Do they need to position their products better? Do they need to change their products? Do they need to do testing on what their customers are wanting? I think there's more to the story than just businesses aren't spending. I don't know. Maybe I'm just giving everybody a hard time.
Well, I think it's been clouded by the fact of some of the bigger names like Google, who announced a dividend. Yeah. And rip-roaring response, right? That kind of clouded the fact that their AI output isn't very great, right? And they've actually still pulled live instances of the AI product from the marketplace because it wasn't ready for prime time, and it still isn't. But the market responded pretty favorably to the buybacks. Apple was another example where they do have a fundamentally slowing business, but they keep announcing more buybacks, or they keep announcing something that isn't product related, more financial engineering versus here's our bad news, we're not selling as many products as we once did, versus we're going to start using all this cash pile to really not invest in R&D or invest in the future, but to reduce the share count. Share count. It's just kind of wild.
Man, there is a lot weighing on. I feel like it's every other week I see an article. Apple's going to announce AI iPhone soon. Get ready. And like, if I know anything about Apple, they don't release anything before they release it. They don't provide any hints. Nothing. Like even their emails when they announce their events, that's like a very cryptic email. The words are just kind of meaning something, and it doesn't say anything. Like that's just the MO of the company, right? The media and the market and potentially what's priced into that stock is this AI iPhone or whatever their flavor that's going to be. Man, I hope they can deliver because the market's definitely expecting something in September when they release the new phone.
Yeah, because what has it been a string of? Oh, a new update in Mac. We're bringing our chips in house. Nothing really earth-shattering, right? I think as an Android person,
got an AI bump.
Yeah, I'm an Android person, so I think I say jokingly, but I think they would see a 10% pop if they said, "Hey, we're gonna take Siri out back and put her to pasture because it's been a dog."
Siri's so bad.
You think about a tech company who has not invested in R&D in the right places, because what's come out? Maybe the watch, the EarPods, right? So two products since the iPhone that have been really big.
but they've been able to expand the price of all these things and expand their margins. Like, I think the most impressive thing about Apple is they charge a lot of money for their phone and people buy it.
Yeah.
And it's like, I think the iPhone's the most profitable product ever created. If I had that stat right. I mean, it's amazing. And then they're able to then sell these ancillary services that attach to the one product.
I think that's the key. The
pods,
subs, yeah. The subs,
the
too.
subscriptions, this and that and the other, right? And that's kind of what Tim Cook's done, and why the company's then propelled to kind of 10x where it was with just the iPhone, because of all this expansion of products. We'll see how the Vision Pro does. I think that'll be interesting if they choose to break that out in a couple quarters on earnings. I don't believe they are now. I think they're just lumping it into their regular numbers, which is a typical company thing, typical Apple thing too, just to sort of hide a new product until they want to reveal it. But yeah, I think the most impressive thing about Apple is their ecosystem and how they've been able to build and kind of cross-sell from the iPhone. So I don't know that Mac sales have really grown substantially in the last, decade. They've maybe grown a little bit, but it's all been centered around the iPhone, which is impressive.
For sure.
No other company in history has ever been able to do that. I can't believe you're an Android person. I'm going to buy you an iPhone, and I'm going to ship it to you.
No, I don't know if the new iPhones use USB-C anymore, but we would have to convert all of our charging plugs to whatever antiquated system that Apple uses.
Boo-hoo, but perfect. Yeah, once they do that, I think they are doing that, and then that's perfect time for me to send you one. Because I can't stand your green text messages. I can't stand them.
They got it. I think they're fixing that because there's like an antitrust issue with that.
Nah, they'll be fine. They'll be fine. It's a superior way to send a message. We all know this.
Everyone wants that blue box who's the Apple user.
It doesn't hurt the eyes. It's nice on the eyes. The green box hurts my eyes.
Yeah.
And that's when you text me. All right. AI. Good segue to AI. So a record number of S&P 500 companies are mentioning AI on their earnings calls. No surprise. We've got a chart here that is showing this really started spiking right at the end of 2022. AI was a thing that maybe, 60, 70 companies would mention. Or sorry, number of times. Number of companies. I'm butchering this. You take over. Take over the chart.
Yeah, the number of companies went from, I'm eyeballing.
Yep.
Yeah, but it's like 90 companies in 2022, up from 60 to close out the year. And then 2023 started. All of a sudden, we started hearing more. 140 different companies mentioned it. And then a record in the second quarter where it was 175 companies mentioning AI, where it closed out the year at 190 when Chris and I mentioned it, saying it was a record. So this last quarter, a new record of 201 companies mentioning AI of the S&P 500. So if you're doing any kind of counting here, there's more companies mentioning AI than there are tech companies in the S&P 500, right? That would anyone who's mentioning it has some kind of, incentive to mention it. And I think that's what Chris was getting at with the herd mentality of all these earnings calls. Mm-hmm. There's some kind of underlying incentive to at least sell the stock price, or at least sell the company, right?
Yeah. I mean, we didn't sell our products this last quarter, but we're investing in AI.
Yes.
Boom, stock goes up, right? Like Wall Street doesn't care that you didn't sell your products, but you're investing in AI, therefore you get a bump. And that's interesting.
Yeah. So Dell came out with their earnings either this morning or yesterday where, yes, we've benefited from mentioning AI. Guess what, marketplace? All the AI server space that we've been selling, zero margin. What kind of business is that? Now Dell is down 17% because they couldn't prove that they can monetize AI. Mm. So they spent all this money, recoup their costs back. That's it. Zero profits.
Wow.
So I think the marketplace needs to continue to set a prove it mentality, because the more and more companies that try to push this hype, we're starting to get into that crypto stage where we're that Lemonade company I mentioned, where they said Bitcoin Lemonade, or where they named themselves and they were up 100%. If we're starting to see more and more of that, companies like Adele, not the singer, Adele, the computer, need to get hammered for not making any money on this stuff, right? NVIDIA is a different beast. They have like 70% margins, but anyone in NVIDIA's purview, I'm looking at Supermicro, Dell, Cisco, Oracle, who have all been pumping the AI train, they have yet to prove it, right?
Because they can monetize it. Yeah, it's all cost at this point.
If I'm a zero margin business, that shouldn't be rewarded at all.
What's interesting is these huge companies can afford to lose money on something until everybody else fails.
Yeah,
like that's kind of what's interesting in today's market, right? Like Microsoft can lose billions of dollars on a product for a long time and be fine because it'll just get absorbed in their cash flow, and in a way that that power is a bit dangerous, right? Because if I'm a startup and I'm trying to compete, Microsoft can spend more than me, lose more than me. The VCs are going to shut me off of my startup before Microsoft runs out of cash.
That was Google in its heyday, right? Like it was like a seed generator. Exactly. Within the company, yeah.
Exactly. It's like what's the Warren Buffett quote? The market will stay. You won't stay solvent as long,
longer than the market is irrational.
Yeah. You'll go insolvent before the market is
comes to its senses or something like that.
Anyway, yeah. Google that. It's a good quote. But that's the thing, right? Like these big companies can just keep spending and spending and spending, and obviously they're concerned about their bottom line, but it just doesn't even phase their profitability.
No, because it's a big build out that you need to train your AI, get new NVIDIA chips, because NVIDIA is the only one that's selling capable.
Yeah, of course.
Yeah. And then servers from Dell at zero profit to Dell, right? Like there's this big infrastructure build out that let's say you're a grocery store. How much are you really going to spend on that when your margins are, say, 3%, 2%?
I mean, Kroger's not, but Amazon will. That's my point, right? Like Amazon can spend money on AI to make Whole Foods better, and
correct.
Maybe Walmart. Actually, maybe Walmart, maybe Costco. So now we come back to the big of the big, but then if the big of the big can create these tools and then sell those tools down the line, everybody benefits. But we're a lot of innings from that happening.
Yeah.
If we're in inning 1 or 2 of this stuff, there's at least a decade before it actually reverberates through all companies. What was that thing you sent me the other day too? It was like the actual market capitalization realized from the AI boom was $3 trillion, but the anticipated additional revenue was 30 billion.
20 billion, yeah.
That's so crazy.
So the hype, that was from Scott Galloway. He was just saying any AI related company saw a 3 trillion market cap increase, plus or minus a few hundred billion.
Sure.
But the addressable market that AI is anticipated to bring in, right? 20 billion in new revenue. That's not, I don't know if that speaks to any efficiencies, but as I mentioned, to get those efficiencies, you need a pretty large build out.
Yeah.
And I think we'll talk to one of the other input components that you'll need to pay for to keep AI humming for your business. So he's arguing that AI is in a bubble. I don't know, because people were saying the internet was a bubble in '99. It was in 2001, but look what it came out to be.
And that's I think the point, right? Like every company is being bid up by this right now. There will be winners. There will be definite winners, but it's just not clear on who they are. I think everybody thinks it's going to be the obvious ones. It's going to be Microsoft. It's going to be Google. It's going to be Amazon with AWS, right? These are going to be the clear winners. NVIDIA. But I don't think that's totally clear at this point. We're driving through the storm right now, and everybody's getting bid up on that news.
And the market's rewarding the loudest voices at the moment.
Yeah.
But a day like today kind of reminds everyone that valuation will eventually matter.
Okay, so let's move to this electricity thing. So this is interesting. So Sam Altman was recently at the World Economic Forum, and he was talking about how AI needs so much electricity that tech companies are going to be getting into the energy business in order to create a more efficient way to buy power. So talk about this. Like, talk about the power and talk about what you're seeing with some energy stocks recently, because I think this stuff is super interesting.
Yeah. So if Google were to integrate generative AI into every search, the electricity use would rise to something to the tune of 29 billion kilowatts per hour, and that's more than the entire countries. So, one, you've heard of like the Texas grid failures, right? During heat, California too, to be clear. How is the current infrastructure going to handle any of this? It's not. I don't think we have enough power generation for one, and two, the grid is a power transfer tool, right? So if I use electricity now at this moment, SMUD, which is the local utility here, they are producing on demand, right? I don't have a battery on the property. I don't. The grid doesn't have any batteries, so when the community pumps up, because it's hitting 97 today in Sacramento.
Wow.
When we crank up our ACs, guess what the Cal ISO, which is like the big state utility regulator, they pump up the need for electricity in the moment, right?
Yeah.
And let's say you undercut that or you underproduce. That means you're going to get brownouts, blackouts, things like that.
Right.
If you throw in crypto mining, you got places in Texas that are completely being drained by crypto miners, which, whether they have a benefit to society or not, they're let's throw that out. Let's look at how much energy they're using. What's that doing to the rates across the world or across the country, let alone Texas, right? So I think that increased power requirement is going to be a big issue.
Here's a fun fact for you. Last year, Amazon, which is a major investor in AI company Anthropic, said it invested in more than 100 renewable energy projects, making it the world's largest corporate purchaser of renewable energy for the 4th year in a row.
Yeah.
Wild.
And all this build-out is not for the benefit of the country. It's probably for the benefit of increased computing power needs. So let's say AI is kind of a dud. It doesn't. People are over the fact that, OpenAI is more of like a hyped-up Siri, which is probably the worst-case scenario for Microsoft. But all this increased computing power will be used in some form or fashion, most likely by Microsoft, Google. It just won't be in the AI wrapper, right? And I think these big companies are going to find a way to improve our lives technologically and make things faster. So we're going to need a improved grid and improved energy generation.
According to Sam Altman, he says he doesn't see how the increased needs can be met without a breakthrough in energy technology.
Yeah, he's calling for fusion technology, which doesn't exist.
Right, it's still in testing. It costs a lot more power than it generates, but that's just because it's being tested. So, interestingly, up here it actually says Microsoft is working on getting approval for nuclear energy to help power its AI operations. So, it'd be interesting to see what tech does to try to circumvent, the utility companies, because it seems like the utility companies probably can't build fast enough, can't give them enough power, and again, it comes back to these tech companies can continue to vertically integrate themselves because they have just so much money.
Yeah.
Let's move into what are you seeing with some stocks here? So you've got a year-to-date chart with some stocks. Just unpack this for our listeners on what you're seeing in markets as it relates to power and the AI trade. Yeah,
I think the rational thought is all this increased power usage is going to benefit utilities, right? They're the arbiters of power transportation, at least. So you would think more people use electricity, utilities bank in, roll in the money, right?
Mm-hmm.
That's not really the case. The XLU index, which is just all the utilities, it includes some high flyers, It's up 13.83%. Actually, pretty good. But you look at some of the more traditional utilities aren't doing so good because of the structure. So a regulated utility like Con Ed, Seattle City Light, they operate under a cost plan, meaning if I spend $1 million in distributing power, I can recoup $1 million back. That's it. No more, no less. So the more and more Chris uses up there in Washington doesn't really add to the bottom line to Seattle City Light. I don't know. I'm assuming they use them there in Kirkland, but
Puget Sound Energy over here, but
yeah, same thing.
Same thing.
Same model.
Yeah.
Because it's something that's been regulated over the last 100 years, where utilities back in the day took advantage of customers, and states and the federal government stepped in and say, "Hey, you can't charge more than what your cost is," which is kind of wild. It's like we were saying, is you can't make any profits on your utility. So how do utilities stay in business? Well, they have another wing of their business where their job is to build out infrastructure, and there they can charge a 10% margin. So if I'm putting a new grid or putting in new lines, it costs $1 million, I can charge $1.1 million. So that's how utilities make money. So this AI build out could, down the line, help the traditional utilities, but that could take decades, right?
Yeah, because it's a government thing, right? So because if Puget Sound Energy wants to build another substation or run some more wires or whatever, and get a 10% premium, they don't send me the bill for that. And
correct.
Similarly to what you said, they don't build in those costs to my like monthly or bi-monthly bill. So it's ultimately like government subsidies and whatnot that pay for these. Because of course, you say, well, they can make a profit. It's like, well, why don't they do more of it then? Because I'm only reading that the grid needs upgraded and stuff. It's like, well, I'm sure they would want to, but it's because the check needs to be written, probably from the federal government, maybe the municipalities, I don't know, to reinvest in the grid. Yeah,
who would have thought the utility business was so complicated?
Right? Yeah. Interesting. I mean, I guess it's a good thing that it's regulated to not make money on the on the monthlies, right? It's like they're not profiting on the gas bill type thing. That's good. They're just trying to break even.
Yeah.
But that's an interesting incentive around the build out.
Yeah. And listeners are probably saying, when are these guys going to give us some investing advice? Because I think the companies
in the rearview mirror, we've got some great investing advice.
Yeah, in the rearview mirror.
Yeah.
This is a company we brought up with the top best performers in the S&P over the last few years. Vistra Corp, VST, was one of them. Surprise, surprise, they produce energy, and they sell energy to these utilities that are unable to meet those demands where, it's hot in California, we use our AC.
Yeah.
Who's selling that to California if their power plants, wind plants, whatever power generation is insufficient? It's a company in Texas called Vistra Energy who has a nuclear power plant all across the world or the country. So they've benefited. They are up
166% this year.
166% this year, right? So NVIDIA's up pretty big too, but this is a company that doesn't get a lot of news coverage, but they benefit from selling more power, right? And they sell power. They don't transport power. First Solar is the next one. They, until very recently, they were pretty flat, but guess who's going to benefit from increased power demand? That's going to be those solar companies that actually produce power.
And also build, right? First Solar, I assume, builds, so they've got some sort of profit margin in their
their panels. Yeah. Nextra Energy, which is, I believe, another solar company, they're only up 27%, but that's pretty good. NRG, which is a Houston-based company, it's 68% up. Constellation Energy Group is up 98%. And this is all through just like May 24th.
Interesting. It's actually all been pretty consistent, with the exception of First Solar. First Solar jumped within the last week or two, which I think is kind of what caused this chart. It's like, whoa, it jumped a ton in a day. The rest of these, though, it actually looks pretty consistent here. They've sort of been climbing throughout the year.
And if you look back to 2023, when the AI hype was really high, Vistra Energy, which is on our top performers in the S&P, had a very similar year too. So
interesting.
There's a lot of people who already thought ahead of us, right? Like,
sure.
What am I going to tell the market that it doesn't already know? It's kind of the other way around, right? So a lot of investors got wind that Vistra Energy was going to be a big beneficiary of demand. And there you go. It's already reflected in the price.
Yeah, lots priced in now.
Yeah.
Just like a lot of these companies. Okay, good stuff. Well, thanks everyone for tuning in today. I hope you found today's episode informative. I sure did. I learned some stuff. We'll catch you again in about 2 weeks for another update on interesting facts in the market. And as always, ping us if you have any questions on anything. Thanks everyone for tuning in.
Thank you.